Okay, so IS 23 on borrowing costs. IS 23 on borrowing cost. And what we'll look at here first, we'll look at majorly the core principle, then how you recognize and majorly disclosure requirements. This is also a very short standard. And the core principle here for IS for IS 23, the core principle is that when you have when you borrow money when you borrow money to construct an asset, any asset, when you borrow money to construct an asset, the interest you are paying on that borrowing should be capitalized. Again, the core principle here is that when you borrow money to construct an asset, the interest you are paying on that borrowing should be capitalized. That's the core principle here. So the standard called the asset that you want to construct, the standard called it a qualifying asset. Called it a qualifying asset. So the interest you are paying on that qualifying asset, the interest you are paying to on that borrowing, add it as part of the cost of that asset. That is everything this standard is all about. It's not more than that. Though there are some exceptions, like for if the asset is an investment property, then um, you say you should not capitalize the interest, or if the asset you are constructing is inventory that you want to sell, or something, you should not capitalize the interest. But those ones are not. But what I need you to note right now is that when you are constructing an asset, then that asset becomes a qualifying asset, right? So the interest you are paying on the money you borrow from the bank to construct that asset, that interest is the focus here. And that's what they call borrowing cost. And that interest has to be added as part of the cost of that asset. And and that's that. So um so again, all of this is just we're addressing that. Now, the thing is this: when you borrow, two things can happen. Like you can either borrow for a specific asset. So we'll look at an example of that here now. You borrow for a specific asset, or you have an existing pool of borrowings. You have an existing pool of borrowings, meaning you can borrow from bank A, you borrowed from bank B, you borrowed from bank C. So maybe you have a debenture in your books already, or you have, sorry,
Person should mute their phone now.
okay, or maybe you have
I
a
wanted to
bond,
buy.
or maybe you have a
I
commercial
then
paper
I
in your
wanted to buy a
books.
chair. Right? I was taking the chair. Now I cannot make chair. Can she take one? Can she take? And yet,
Please, can you mute everybody, sir? I think you can mute from your end.
Yes, yes,
Mute
yes, yes,
everybody.
yes. I think I've actually done that. So, if the entity has a pool of borrowings like bonds, debenture, commercial paper, it has it there already. Then that one now, you can then take out of that money to construct an asset. That's a different treatment, which we are going to come to. So let's start from the simple one, where an entity borrowed money to construct a specific asset. And from what I've said, the interest you are paying on that borrowing, that interest, you have to add it to the cost of that asset. Okay. However, if that money you borrowed, right, if you are not using everything at the same time in such a way that you could invest surplus funds from the money you borrowed. You see, the income you earned or the investment income you earn from that surplus funds, you can use it to net off your interest that you want to capitalize. So all your capitalizing become reduced. So instead of recognizing that investment income as finance income in your P&L, you just use it to net off your interest that you want to capitalize, right? Then before you then add the net to the costs of that asset. Let's look at this question. This question would really show you what I'm talking about. So for specific borrowing now, so on January 1st, 2016, Wellman Limited the guy borrowed 1.5 million to finance the production of two assets, both of which were expected to take a year to build. Work started during 2016. The loan facility was drawn down and incurred on 1st January 2016. All this is saying is that they started spending it in 2016 and was utilized as follows. And they also told us that with the remaining funds invested temporarily. So this is what I'm talking about. So if they don't use all the money at a go, whatever money that is remaining can be invested so they can get money from it. So on 1st January 2016, so they spent 250 on plant, 250,000 on plant. They spent 500,000 on building. They didn't start spending the remaining money, 250 for plant, 250 for building, until June 1st, 2016. What that goes to show is that from January to end of June, they had 250 plus 500. They had an extra amount of almost 750,000, which the question told us they could have invested, right? So we're now told that the loan rate is 9%, and Wellman can invest surplus funds at 7%. And I said, ignoring compound interest, calculate the borrowing cost, which may be capitalized for each of the assets, and consequently, the costs of each of the assets as at the end of the year. Now, this is the solution. So let's calculate the interest first. I mean, the borrowing costs. Since there are two separate assets, you have to know how much interest are you capitalizing for each class of assets. For plants now, at the end of the year, for plants, they spent 250,000 from January to June. They spent additional 250,000 from July to December, right? So they spent an entire 500,000. So the interest you are going to pay on that is 9% of 500,000. Okay, and that is 45,000. That's for plants. And for building, it's going to be 9% of 1 million, and that is 90,000. That's the entire money spent. We had an extra 250,000 between January and June for plants that we did not spend because we didn't start spending these plants, this remaining 250 until July. So we invested that and got 7%. So we only got 7% for 6 months. So 7% of 250 multiplied by 6/12, we got 8,750. That will be deducted from the borrowing cost. The same thing applies for building, but this one now, the extra funds we had was 500,000 that we did not start spending until July. So we had it for 6 months, which we invested and got 7%. So we got 17.5. So our total borrowing cost that we will capitalize for plant is 36,250, and for building is 72,500. And that's the calculation of the borrowing cost. Now let's determine the cost of the asset. The plant, the cost of the plant or the expenditure incurred on the plant was 500,000 in total. So expenditure incurred 500,000. Borrowing cost that we will capitalize is 36,250, which is this, which we added here. So that means the cost of the plant is going to be 536,250. For the building, the expenditure incurred was 1 million, which is the addition of this. Expenditure incurred 1 million. The borrowing cost we capitalize is this, which is this 72,500. And by the time we add the two together, we have 1 million and 72,500. And this solves that question. Now, the second one, which is a scenario where is not as direct as this one, that we had pool of funds existing down. See, the only challenge we have there is this. While for this one, it was easy for us to know the rate of this loan, this 1.5 million loan that we got. It's very straight. We can easily know, okay, what is the borrowing cost rate we will use to calculate our interest. But by the time you are using pool of funds, maybe fund A was a bond that we borrowed at the rate of 8%. Maybe fund B is a debenture that we borrowed at the rate of 10%. Maybe fund C is a loan that we borrowed at the rate of 5%. So which of those rates will represent our borrowing costs or that we're going to use to calculate the borrowing cost? The standard said you use a capitalization rate. And how do you determine capitalization rate? I will show you with an example so that it will be clearer with that. So that's the main thing there. When you are using pool of funds or pool of borrowing to finance a singular asset, then the interest you use is a capitalization rate. So let's look at this question to address that. So this question says that Power Limited had the following loans in place at the beginning and end of 2016. So it had a 10% bank loan, 9.5% bank loan, 8.9% debenture. So these are different funds, right? So for the bank loan and this other one, they were there. That means he has taken it before this period. So that's why it is there at the beginning and at the end. But for this one, I think he took this one from what I'm seeing here. Since it's not here at the beginning, that means he took it during the year. That means he took it during the year, yeah. So you're now told that the 8.9 debenture, 8.9% debenture was issued to fund the construction of a qualifying asset, which is a piece of mining equipment, and the expenditure incurred was 40 million, construction of which began on 1st of July 2016. Okay, so that means out of these funds, out of these three borrowings, this particular one, this 8.9% debenture was used to fund a specific asset. So that part is straightforward because you can easily know that the interest to capitalize is just this 8.9% of the expenditure incurred. That's another thing. The interest you capitalize is the interest not on the entire borrowings for a year, but on the expenditure incurred to the end of the year. So it's going to be 8.9% of 40 million. That one is straightforward. We're now told that on 4 January 2006, Power Limited began construction of a qualifying asset. This is another one. A piece of machinery for a hydroelectric plant using existing borrowings. What they are saying there is this. That means since he has used this for this other one, then for this other asset, he will use this 10% and this 9.5%. And that's what we call using generic borrowing or pool of funds, right? So the challenge becomes, are we using 10% or 9.5% as our interest? We'll get there. But they told us that the expenditure drawdown for construction was 30 million on 1st of January 2016. Okay. And 20 million on 1st of January 2016. Okay. So we're now asked to calculate the borrowing cost that can be capitalized for the piece of mining equipment and the hydroelectric plants. Right. So It's two things, right? To calculate the borrowing cost. Here, they didn't tell us that they invest any surplus funds. So you will not assume that, since this 8.9%, we only spend 40 million, that means the remaining, no, 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 no. As, unless they specifically tell you that they invest surplus funds, please don't assume. So for the borrowing cost for this mining equipment is simply 8.9% multiplied by 40 million. But since construction began on 1st of July, since construction began on 1st of July, that means we are going to prorate it. Let me show you. This is it. So the 8.9% debenture was issued to fund a specific asset. So it's simply going to be 8.9% times 40 million multiplied by 6 over 12. That means the borrowing cost we'll capitalize is 1.78 million. That means at the end of the year, the total cost of this mining equipment is going to be 40 million plus this 1.78 million, and that's it. We are now told that the remaining borrowings, this is the solution anyways, that the remaining borrowings are 10% and 9.5% bank loan, which were applied on the construction of the hydroelectric plant. Then we're going to use a capitalization rate. And this is how you calculate capitalization rate. From here now, what I did is 120 over 200. And this 120 represents how much we borrowed at 10%. This 200 is the addition of this 120 we borrowed at 10% and this 80 we borrowed at 9.5%. So this is just like a weighted average. So the interest rate for the 120 million, which is 10%, times 120 over 200, whatever you get here, then you add it to the 9.5% multiplied by the money we borrowed at 9.5%, which is 80 million, divided by the pool, the everything. So when you do the maths on your calculator, you get 9.8%. So this is what they are saying now. So the remaining 9.8%, sorry, the remaining 10% and 9.5%, we borrowed 120 and we borrowed 80. So for us to know the interest we will use, we use the weighted average of those two funds. So we did 10% multiplied by 120 over 200. So that 200 is 120 plus 80. Whatever we got, we now did add 9.5% multiplied by 80 over 200. So that's just like a weighted average. So that gave us it gave us 9.8%. It gave us 9.8%. So now this 9.8% now, since to now determine the borrowing cost, so they did 9.8% of 30 million, right? This 30 million, when was this date? They said expenditure drawdown for the construction was 30 million on 1st of January 2016, right? So they did 9.8% multiplied by 30 million, right? And this 20 million on 1st of January 2016, here they did 9.8% multiplied by 20 million, then they multiplied by 3 over 12. Then they multiplied by 3 over 12. Because this one was drawn down on 1st of January 2016. Then let me
So is
see.
it first
First
January
of
or
October.
October? You'll be calling it January. It's not October. Be
Which
a
one?
mistake.
Which one? Share this
That
one.
20 million you wrote that so I'm seeing first October 2016, but you're saying first January. I don't know, is it a
Okay.
mistake?
No, no, no.
Typographical error.
No, no, it's not a mistake. So it's 1st of October. Okay.
Okay.
So which is why that 20 million, when you wanted to calculate the interest on that, it was 9.8% multiplied by 20 million multiplied by 3 over 12. So they prorated this portion. So that gave us the borrowing costs as 3.43 million. So at the end of the year now, if you want to calculate the total cost of these hydroelectric plants now that they use pool of funds for, it's going to be the total money incurred, which is 50 million. Then you will add this 3.43 million. So that means the total cost is going to be 53.43 for the hydroelectric plant. So the major point here is this, that when you see a question giving you pool of funds that they use to fund a particular asset, the major task there is for you to be able to determine the capitalization rate. It's just like a weighted average to determine the rate. And another thing I'm seeing here is that these rates, they are not calculated on the money that is borrowed. They are calculated on the expenditure incurred. So you have to be very careful there. Very, very careful. The rate is not calculated on the money borrowed for you to know the borrowing costs. You apply the rate on the expenditure incurred. So please take note of that. So, and that's that. So finally, we'll look at all these other details, but
Sorry,
let me have your
sorry,
questions.
sir.
Yeah,
I have questions, sir.
please ask.
Okay, my concern is this 20 million that was drawn on the 1st of October. I'm trying to play devil advocate by saying that this 20 million should have included the 8.9% of that, the remaining fund from the 150 million. Is it not possible? Or is it because the question was silent about that? That's why we didn't include it. Because the money to have been, the loan was taken at that period. That 150 million that we use for the first the first line of construction.
Yeah, I understand you clearly. So, yeah, it's possible, right? But again, I can't assume. I can It's very dangerous to assume in the exam, right? Especially a question that is straightforward. You don't complicate it, right? So since the question has told me that they use the 8.9% for this one, right? And they now told me the existing one, oh, they now use it for this one, for this particular asset. So I don't want to start unfolding things. No, I will just know that the 8.9% is dedicated to that. So far they have incurred 40 million. So that means if they need more money on that asset, that is where they would, meaning that was what that borrowings was meant for, is for that particular asset. Then the remaining two, the 10% and 9.5%, is for the hydroelectric plant. And that's how you should say.
Sorry, sir. I have a brief question.
Okay?
So, the thing is for the capitalization rates. Should we just say, okay, oh, since we have two rates, 10% and 9.5, can we just add the two rates and divide by two to get the capitalization rate?
No, don't do that. You have to use the weighted average as prescribed by the standard. Okay? So, because it might not be 2 now, if it's 4, so you now add the rate and divide it by 4. It won't work. So you have to weight it based on the money borrowed, right? So for this 10%, you borrow 120 over the total plus 9.5. This one multiplied by 80 over the total. There could be more. So you just continue like that. So
Okay,
don't
sir.
don't do that average.
Okay, thanks.
Yeah, I'm with you. Yeah, I'm with you.
But you said the interest rate is calculated based on the beneficiary showed on the qualifying asset, right?
Yes.
Okay, assuming you borrow 8 million naira from bank on stock to qualifying asset of let's say 15 million. So what happens to 5 million that you have not yet expended?
If I get you rightly, because I didn't hear you very well to be sincere, I think what you're trying to say is this, that interest is calculated on the expenditure incurred, and that if you borrowed, let's say 10 million, you are going to be probably be paying the interest on the 10 million to the bank. And if what you have incurred is, let's say, 5 million, to date, we are seeing what you should capitalize is interest on that 5 million. So what happens to the extra you are paying to the bank as interest? You expense it.
Okay.
You expense that
Okay.
portion.
Another question
Okay.
in the course of constructing a profile, sometimes engage in advertisement. Well, that advertisement cost, how are you going
I'm struggling to hear you.
the net of
Sorry?
the net of bad
It's not bad, it's good.
what I'm saying, Vanessa,
Yeah, go ahead, please.
okay, if you construct a qualified asset, sometimes you engage in advertisement. So what happens to the advertisement cost? Is it going to be capitalized?
Oh, okay. So that one, you judge that one in line with PPE now. Is advertisement cost directly attributable cost? And if you remember, PPE specifically mentioned that cost of opening a new location or in a new location that should not be capitalized, like advertisement and all of that, because the asset is already ready for use. So you cannot capitalize that. Okay,
Okay, sir. Sorry, sir. I have a question, sir.
please go ahead.
Okay, it's very clear that we'll capitalize the borrowing cost, but I'm skeptical that okay, I've capitalized it in my book, but did the same amount I capitalize also need to be paid to the bank? Because the bank is not part of my book. So the amount I capitalize, how do I don't know. I'm also expected to pay that amount because the bank will take its interest, whether I capitalize or not. Bank will still get the interest paid. So the portion I capitalize, how do I recognize the payment I will still make to the bank?
Credit bank now. When you debit the asset, you credit bank.
Oh, okay,
Yeah.
okay.
Any further questions? Or should I round up? Okay, so I've seen in your exam severally that they ask you that you should state the criteria, or yeah, the criteria for capitalizing borrowing costs, meaning the recognition criteria. So, and that is what I call here commencement of capitalization. So you have to, whether you have to come, this is something you have to know for borrowing in IS 23, that before you can start capitalizing, then the expenditure must have been incurred. You must have started spending money on the asset. You must have borrowed the money, right? You're already paying interest to the bank, and you're already making arrangements to start construction, right? So when we say activities in progress that are necessary to prepare the asset for its intended use, doesn't necessarily mean that you have started physical construction. Even if you are still getting building permit from the government, you are still trying to do soil tests. The point is that your work is in progress already, so you can start capitalizing it. So three things must happen: expenditure on the asset is being incurred. You have started spending money. Borrowing costs are being incurred. Activities are in progress to prepare the asset for its intended use or sale. So those are the three um, criteria before you can start capitalization of borrowing costs. Furthermore, is that you can suspend borrowing costs, meaning that you can suspend capitalization of borrowing costs if active development is interrupted for an extended period. If active development is interrupted for an extended period, then capitalization can stop. An example of that is that maybe government gave you a stop order and you cannot continue for almost 1 year or for